Let's talk about switching payroll providers in the middle of the year. On the surface, it can seem kind of simple. We're unhappy with our current provider, we find a better one, and then we make the change. But in practice, especially for moving companies with hourly labor, overtime, multiple crews, the state level compliance, a mid-year payroll switch is one of the most technically risky administrative changes that you can make. And we've seen this firsthand many times, and it's important to understand why it causes so many problems. So why are mid-year payroll switches so problematic? Payroll is not just about cutting checks, right? It's a year-to-date reporting system that feeds multiple government agencies at both the federal and the state level, and sometimes local as well. And when we switch payroll providers mid-year, we're effectively asking two separate systems to share responsibility for one continuous reporting timeline. And that's where the problem begins. So the first issue with the mid-year payroll switch is a possible discrepancy in that year-to-date wage reporting. If prior wages, tax withholding, or benefits are entered incorrectly, or even slightly off, then the new provider may file payroll reports that didn't match what the IRS or the state already has on record. And that creates these discrepancies that don't show up immediately, but months later they can cause notices and penalties and things. And then it's difficult to produce an answer to that discrepancy, which really causes stress for us accountants and to you as a moving company owner as well. The second issue with a mid-year payroll switch is conflicts in the quarterly reporting. So payroll operates on quarterly filings, Form 941, all right, that's at the federal level, and then equivalent state forms. And a mid-year switch often splits a quarter between those two providers. So if both providers submit filings without perfect coordination, then we can end up with duplicate wages, missing wages, or even duplicate tax payments, or at least records of those things. And so all three of those scenarios can trigger IRS or state inquiries, which nobody likes. The third issue with a mid-year payroll switch involves state income tax reporting, which is where things really become complicated because most states require income tax withholding through payroll reporting. And that means that the payroll provider is not just calculating pay, it's acting as a compliance intermediary within the state as well. However, as you might know, not all states operate the same way, right? There's 9 states with no state income tax where this specific issue doesn't really apply. Those states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. So if you're in any of those states, lucky you. For companies operating exclusively in those states, then state income tax complexity is reduced. There's like none. But for most moving companies, especially those operating in states with income tax or across multiple states, a mid-year switch can really result in conflicting state filings, incorrect employer account attribution, or notices claiming taxes weren't paid or filings weren't submitted, even if they were. And this happens because the state sees inconsistent data from the two different payroll systems, and it causes all kinds of issues. Another common issue with a mid-year payroll switch is benefit deduction tracking, right? Health insurance, retirement contributions, garnishments, and even PTO, right, is all accumulated over the year. And if these balances aren't migrated perfectly, then employees can end up over-contributing or under-contributing or receiving incorrect year-end totals on the W-2, which again, no good. And at this point, corrections really become expensive and really time-consuming and very difficult. And finally, the most important and detrimental risk with a mid-year payroll switch is inaccurate W-2 filings, okay? At the year end, the IRS expects one clean, accurate W-2 per employee that reflects the entire year. And as a company, you send these forms along with the W-3, which is just a summary of your company W-2s, to the Social Security Administration, who, FYI, imposes massive fines if you don't submit them timely. So send them timely. Okay. When two payroll providers are involved, even small inconsistencies can cause incorrect box totals on the W-2s or 3s, employee confusion, amended filings, and honestly, really avoidable compliance exposure. So if you're going to switch payroll providers, we almost always recommend the switch be effective January 1st, okay? A January 1st switch creates a clean break. One provider owns the entire calendar year, one sets up the quarterly filings, one W-2 source, one state reporting timeline, right? There's no overlapping of these wages. There's no split quarters, no contradictory filings. So from a compliance perspective, it's dramatically safer, it's cleaner, it's easier to audit, and it's easier to defend in the case of an audit if questions come up later. Mid-year payroll switches are not impossible, okay? But they are very risky, and they require a high level of scrutiny if you don't want to end up with an IRS IRS notice or penalties, especially in the moving industry where payroll is already complex and employee turnover increases that reporting requirement. Okay. We've seen well-run companies spend months trying to unwind problems that could have been avoided by just delaying a switch to January 1st. Okay. So that's why if you're planning a payroll software switch, shoot for January 1st versus a mid-year switch, and I promise you're going to thank me.